Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, and good evening, wherever you are reaching out from in the world to listen to today's episode of The Debt Doctor. Thank you for listening to the podcast and joining us today. We're going to talk today about asset-backed lending and lending from the perspective of the lender. We're going to talk about loans, and we're going to talk about debt and lending debt and the value of debt, and how banks and lenders think about it from the perspective of the lender. And we're going to tie it into a conversation we had on a recent episode, which really kind of detailed what the secondary mortgage market is. As a reminder, or if you haven't heard that episode and you're new to the idea of the secondary market, it used to really be referred to as the secondary mortgage market because for decades, that's really what traded hands amongst large institutions, pools of mortgages and derivatives, securitizations, bonds, things like that surrounding mortgages. As I pointed out in an episode I've recently posted, the world of securitization, the world of asset-backed lending and asset-backed securitization, bonds, financing of loan products, and then bundling those loans into securitizations or pools or bonds, that has now extended to way beyond the world of real estate. They're doing it for auto loans. They're doing it for student loans. They're doing it for credit card debt. And the reason I point that out and remind you of that now is, to have you thinking about the implications of the economy going in a negative direction in the near term. There's pretty much a general consensus that it's a greater than 50-50 chance that the U.S. will be considered in some sort of a recession by the end of this year. And if that's the case, I want you to keep that in mind. Let's put on the hat of the lender today and think a little bit about what it means to loan money, what it means to recycle that money, how to value assets, and where when I say recycle that money, I speak specifically to the secondary market. The secondary market is not a Whole Foods, it's not a organization, even it's not a website, it's not a stock market where you can go and trade and sign up and trade assets. It is literally, I used to refer to it as the good old boys network, because it was basically a bunch of bankers and private equity guys and guys that ran pension funds and hedge funds, and with enough money to sit at the table and have conversations about purchasing pools of debt. See, where this becomes an interesting conversation from our perspective is in the liquidity provision. If you let's take a step back. So we spoke about the secondary market. We'll come back to that because that's where the banks and the lenders and the insurance companies, everybody's going to get more money to lend out for more loans, right? And in order to get that money, they've got to go take their existing loans that they've made and sell them on secondary. So that's where they go to get liquidity. Liquidity is another name for cash, right? So what's important to understand is how banks and lenders value loans and really look at how do you assess the value of a loan. And this is where it gets interesting. A loan is based upon, it has value if if it's doing what it's supposed to do. If it is a performing loan. Performing loan is the standard loan. It's the loan that you get from a bank, whether it's on a piece of real estate, a piece of a car, unsecured business loan, maybe against some of your business assets, possibly some securitization. But the loan only has value when because of the expectation of future cash flows that the bank or the lender is going to receive. And then further to that, if you get even more detailed, it only has real value if it's performing. I mean, that's where the real value comes from. And then there's other factors that come into how you price and value that loan. In fact, and this is, you'll hear the words mark to market a lot when you talk about financial market. The loan only has value as long as it's performing as intended. And it doesn't even have necessarily 100% value if it doesn't have other terms like a repayment schedule that aligns with market expectations, interest rates that align with current market expectations, and that it doesn't, for some reason, uh, flash a sign or a signal that says that it will stop performing. Because when a loan stops performing or performs not as well, it's sub-performing. Borrowers start getting, maybe they miss a payment, they're 30 days late, they're 60 days late, they get late and then they catch up, or maybe they lose their job and they can't make a payment for 2-3 months. Those non-performances, the when the loan stops performing as intended, it becomes either a sub-performing loan or a non-performing loan. Most servicers will consider loans in sub-performing status for the first 90 days. While they try to talk to the borrower, see their intentions, what's this, how can we get things fixed? How can we work this out? Can we give you a deferral or a forbearance? Can we look at a modification? Do you have refinance possibilities? All of those loss mitigation options start to have conversations. The lenders start to have conversations with their borrower in those first few months as a loan stops performing 100%, as it starts sub-performing and potentially becomes a non-performing loan. What's key to this, you must understand, is that the minute the loan stops performing, if I was the owner of that loan, if I'm the bank or I'm the lender that owns that loan, that gave that loan, and still has that loan on my books, now all of a sudden I have to account for the possibility that borrower is not going to pay. That accounting for the possibility the borrower is not to pay is what I'm speaking about when I talk about loss given default. In a performing situation, you could still have warning signs that a loan could be going bad. If you find out, hey, the borrower just got convicted to 30 years in prison, even if they're a performing loan, that's probably something that you can count on going sub-performing, non-performing. So there's a whole myriad of reasons why a loan would change from one status to another. What's key to this is if you're a bank, the FDIC, the government watchdogs, everybody's looking at that, right? If it's commercial real estate, if it's residential real estate, the banks have to cover all of the capital associated with sub-performing, non-performing loans. Well, and that part of that whole mark to market conversation, right? Because banks are really the ultimate liquidity providers. And, while banks do not hold anymore the majority of the real estate mortgages out there, they used to be. But even in commercial real estate, we've seen private debt, private lending really, really come out of nowhere and take majority share of that market. But the banks still control almost $2 trillion of commercial debt on their books, maybe more, and many trillions more that they own of performing residential debt as well. And on the commercial side, we've seen a lot of this. We've seen a new trick take place just since COVID, where the FDIC, the feds have allowed banks to do. It's called a troubled debt restructuring program, TDR. And if you do any research on it, you'll see that the TDR rates amongst banks is increasing rather than the default rates. So bankers are using TDR as a way to extend and pretend um, sub-performing loans and kind of keep them in this kind of quasi-performing status so that the bank doesn't have to cover that money. But it comes back to net present value. A loan is only worth what it's the face value of what it's worth if it's a performing loan, if it's doing what I'm saying, what it's supposed to, right? And I want you to think about this in terms of what could happen if the economy hits, if it starts to go in the wrong direction, if people start to lose their jobs, if we get into some kind of a conflict with another nation, whatever it might be. We obviously are living in volatile times. But the bank and the lenders who own these loans, to them, liquidity is the ultimate concern, right? Well, if you're a bank and you own loans, it's even more of a concern because you have like your number one job is to be able to pay depositors their money when they come and ask for it. So banks can't have subperforming, non-performing loans sitting on their books for a number of reasons. One, the net present value of those loans is diminished. So, and that's where you get into our game, what I do for a living, right? I act as a liquidity provider to banks and private equity firms and originators and lenders. Except I'm not buying the good stuff, right? I'm not buying the perfectly performing loans that I got to pay 100% for. The stuff that the banks and originators designed for me to buy. That's not what I buy on the secondary market. I act as a liquidity provider to the loans that are sub-performing, non-performing. Why? Well, it's quite simple because in the case of real estate loans or any asset-backed loan that supposedly is at a discounted amount proportionate to the value of the asset it lends against. In the case of those asset-backed loans like mortgages, having that asset as collateral to collect against really does shoot the security of the investment as your lender, as your bank. The security of that investment obviously is much higher when you're talking about real estate or even auto or something that has an actual asset. So that's why I'm not paying 10 cents on the dollar. There's a big misconception that when you buy non-performing mortgages, that even in the darkest days of 2008, which I was right there, this is when I got into this business, when there was no liquidity in the market, when the securitization bond markets froze up, there was nobody to buy even the performing loans, let alone the non-performing, sub-performing. It drove the price of non-performing, sub-performing down into the 20s. We were buying. I remember we bought the first pool of non-performing loans I was ever involved in was the summer of 2008. 3 months before the fall of Lehman Brothers, a colleague from California called me up, said, "Hey, this bank went under. The FDIC is selling their entire tape of new construction loans in Port St. Lucie, Florida. I can name my price. I just got to show the bank what the real estate's worth." I think we ended up paying 28 cents in the dollar or something for that debt. Now, that was because it was proportionate to A, the demand, there was no liquidity in the market, so we got a bigger discount as a liquidity provider. And B, because the real estate values were a falling knife at the time. So really didn't, we were buying $300,000 loans on houses that maybe were worth 100 and would end up being worth 150 or, 125, 175. There was a time in 2009, 2010 where there was something like 40% of mortgages that were underwater because we saw such a huge decline in real estate values in the residential side during then that it wasn't that you had through a stress consideration for in 2007 2008 you started to see a rise in defaults, up to 5 4 5 6 7%. Once it hit that level, it got the attention of Wall Street and everybody, and that's when the securitization started to fail, the AAA, the triple B bonds, the big short, all of that took place. Once you started to see the default rates get to a certain level, eventually defaults in residential real estate got as high as 14% back, I think around 2009 or something, 2010. Something like 14% of mortgages were not being paid, which is a startling figure by all means. By the way, still a small percentage. We're still, the majority of mortgagees are still paying their mortgage, no problem, even when the shit hits the fan, right? But I will tell you as a fact that a lot of that difference between that doubling of the default rate in back in the GFC, that doubling of the default rate. So once you got to 7% default, 6% default, you were already in a really failing market. That was a hugely distressed market. It more than doubled at that point in the year that followed, and it got into the teens in terms of default rates. Where was that driven? That was driven heavily by strategic defaults. These are investors. These are mom and pop. These are you and me. These are doctors and lawyers who, you know, had a couple of single family rental homes, and everybody else had stopped paying their mortgage. Why? And now all of a sudden their house was apparently worth less than the mortgage. So then everyone kind of stopped paying. And this is the thing, folks, that keeps bankers and lenders up at night. It's not a small move in default rates. It's not a, hey, some people in, Amazon is firing people, or there's a certain town where shuts down a plant or something. Or we're not talking about small stuff. We're talking what bankers and lenders are worried about is the big stuff, because we've seen non-performance rates in 2005, 2006, before the GFC. More non the default rates on mortgages are what they are today, 2, 3%, 4%. You know, but it went from 4% to 14% in just a short time, and that's when the banks really started to fail, because when people stopped paying their mortgages, those lenders, the value of those loans on their books disappeared overnight. If I have $1 billion to put to work, or $100 million to work, I'm a pension fund. Why shouldn't, and I have two pools of mortgages to buy. I could buy this pool of mortgages that's performing perfectly since inception. It's got a year or two old. The borrower, maybe some of it's got government insurance on it, you know, and I'm just going to clip a coupon. It's very easy to manage, make a nice, high single digit yield. That is kind of where the world of liquidity plays, right? Versus a pool that is increasing in default rates and maybe even going higher, where's the and has to be managed, has to be dealt with, had to be worked out. That's why non-performing loan pools or loans, even if you buy one individual one, have traditionally sold at a discount to the face value of the loan. This is this net present value. This is this mark to market. This is the market saying, okay, well, that mortgage that you want to sell me on the office building in St. Petersburg, the guy has been spotty on his payments. He's not reliable. Yeah, it's a $3 million mortgage against a $4 million property. So it theoretically has real estate asset coverage. But I don't know anyone, unless it's like a diamond of a property. I don't know anyone that's going to pay par for that. No one's going to pay. You're talking 75 LTV even. It's just too risky in today's market, because value of real estate is based on the income, the cash flow. You can see value on commercial cash flowing real estate. The value could cease overnight if you lose your tenants, if you lose your cash flow there. It's the same as cash flow on real estate and the value of regular real estate being determined by the cash flow. The same is true in lending, even more so. If you don't have a borrower, then you're going to have to enforce that loan. If you don't have a borrower paying on time, and you can't go sell that loan for full value. You're going to have to take a loss, or you're going to have to go and enforce. The reason banks sell loans at a loss is because they don't have the ability to take the to go and deal with the enforcement. They don't have the staff to deal with that. And while they're sitting there dealing with it, they're still having to cover for the cash on their books, because from a mark to market NPV analysis point of view, if the mortgage or the auto loan or the credit card loan stops paying, then it really has no value. I can't sell it. Banks use fair value accounting to measure assets and liabilities at their current market value, and they can use market value as well. But it all comes down to, what will the market bear? So that's an important factor I wanted to cover today, was, really honing in on the concept of how does the market hold together? What is the value of debt if you want to sell it and get liquidity? If you want to get that liquidity back, we know now that maybe that loan only has 100% of its value if it's been performing perfectly. But I'll even go a step further. If interest rates change, and I mentioned that interest rates are a factor in it, the market will not pay 100% for even perfectly performing mortgages that were originated 5 years ago. Because perfectly performing mortgages that were originated 5 years ago were maybe at a 4.5% rate. Why should I go out and take the risk of it buying a pool of mortgages at a 4.5 if I can get that exact rate risk free in government bonds, right? So as interest rates across the board, across the economy have increased, have come back to a more normal level, there's just a whole subset of loans out there, both performing and non-performing, that don't necessarily have the book value, face value that their lenders, their owners would like them to have. And don't get me started when it comes to non-performing debt in other areas, non-asset backed debt, talking about corporate debt, credit card debt, consumer loans, buy now, pay later debt. This stuff is ultimately, there's very little asset security behind any of that. You're having to pursue borrowers, threaten them with credit devaluations, going after them legally and personally, all things that I have very little interest in doing. I'd rather be the doctor than the scalpel. Let's just put it that way. All of that, kind of gives you a glimpse of what we have to talk about in the next couple of years here on the Debt Doctor, doesn't it? Because as default rates, as unemployment increases, as the market economy cycles into a recession, the normal cycles of market economies do, we can expect There will be loan portfolios that will just trade at pennies on the dollar. Maybe not pennies, quarters. And the reason for that is because the banks, lenders need the liquidity, and they don't know how to deal with it. So that's the world that we play in. And it's an important thing to understand, because when you as an investor buying loans, you know the advantage that you have in the free market of the secondary market. As a seller of loans, I know that if there's hair on my portfolio, if there's a loan that's either subperforming, or there's collateral, or there's a borrower has missed payments in the past, I am not going to get the full value of that loan. That's the area we play in. And it's interesting. It's an important thing to understand as we move forward in this conversation about the debt on real estate, the debt on autos, the debt on business assets, the debt on unsecured debt. And what's most interesting will be to see how unsecured debt really does diverge from secured debt. So while there seems to be a lot of similarity in those markets, I know the difference between asset-backed debt and non-collateralized debt. We'll be very interested to see how the rest of the market learns that lesson in the coming months and years. Thank you for joining today's episode of The Debt Doctor. I hope you like what you heard. Please do subscribe, like, and share. And we look forward to sharing more. See you next time. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.